Hello, everyone. Welcome back to SEC Roundup. My name is Tom Zucchero, and I'm on the board of ICANN. With me today, as always, is Nick Morgan, fellow ICANN board member. Good morning, Nick.
Hey, Tom.
We're delighted to have Elliot Ganz with us. Elliot is the head of advocacy for the LSTA, and we're going to talk about a sort of interesting recent case and case development in which the SEC is indirectly involved. This is referred to as the Kirshner case pending in the Second Circuit. The issue in the case is whether a syndicated loan is a security. It's between private parties, but the Second Circuit asked the SEC to weigh in on the securities question, and the SEC gave a interesting and perhaps unusual response. So, Nick, let's start with you to talk about what the case is and the SEC's response or non-response to the Second Circuit.
Yeah, Tom, that's sort of the weird part and the mystery we're hoping Elliot can talk about in a minute. But for those who haven't been following the case or even this particular financial instrument, syndicated term loans, it's a big deal. This is a $2+ trillion market with a T. So it's a large market that probably for the general public goes fairly unnoticed. And so this, as you said, this litigation has been percolating up through to the Second Circuit, and a central issue in the case is whether these syndicated term loans are securities. The industry, the marketplace, for many years has considered them not to be securities. And so when the Second Circuit was presented with that question, they did something a little unusual, which was to reach out to the SEC. And, the SEC, the Securities and Exchange Commission, would be a logical agency to ask, to pose the question to, are these instruments securities? And obviously, with a market this big, with an issue this important, the SEC didn't want to rush in and provide an answer. So they asked for an extension of time to respond, at least more than once. The Second Circuit granted this extension. And then last month, the strangest thing happened. The SEC provided a letter to the court saying, despite diligent efforts, we are unable to provide an answer to the court's question, which for you and me, we're SEC practitioners, SEC Defense Bar. The SEC passing up an opportunity to opine as to whether an instrument is a security is a very unusual thing. So we're hoping Elliot can shed some light on what's going on here.
Elliot,
Sure. Go ahead.
yeah, let me just introduce you and or introduce a question. I mean, obviously, it's important for the entities you serve as a trade association for. So, what's your perspective? I know you were active in the process. Talk to the SEC. Tell us your view and your association's view on this.
Sure. We were surprised, to be honest, very surprised. We were concerned that the SEC would weigh in, as most people expected, saying that loans were securities. So we were delighted to see that they essentially punted. Why they punted is a very interesting question, and have my views. Obviously, I wasn't in the room when they discussed it, but let me take a step back and talk about what the court might have been looking for and what the SEC was facing, and then why I think they came out the way they did. The court asked them a very specific legal question. The question of whether securities, whether an instrument or note in this case is a security, is governed by two cases. The Supreme Court case Reeves versus Ernst & Young, I think from 1990, that has a four-pronged test as to whether the note is security or not. And Banco Español, which is a Second Circuit precedent from a couple of years later that interpreted whether in that case, a short-term loan participation was a security under Reeves versus Ernst & Young. So those are the two cases. What the court was asking the SEC very specifically was, under the four-pronged test of Reeves versus Ernst & Young, do you think the Millennium Labs loan, which is a loan which is the subject of the Kirshner case, is a security or not? Obviously, the SEC can weigh in with that specific test. I think what quickly became clear to the SEC and to others, and obviously to us as a trade association for the market, is that legal question really couldn't be answered without massive political ramifications, policy ramifications. And I think that's why, at the end of the day, they never weighed in. We met with the banking agencies, with the SEC many, many times. We met with Treasury, Fed, OCC. And I think it was clear to the banking agencies that this was not something that they were particularly interested in seeing, meaning the SEC taking the view that the loans were securities and all that meant. And we tried to lay out for the banking agencies and the SEC sort of three things. One is that just having them take that position would cause a lot of disruption in the market. People would have to take, for a short period of time, in the beginning, what does this mean? Is this a policy statement? Is this something they will enforce? So we were concerned about that. Obviously, it had way bigger market implications if the Second Circuit would take that advice and run with it and ultimately rule that loans are securities. We didn't think that the SEC's statement would have legal import, but it would be taken by the market in a very bad way. Secondly, we made it clear to anyone we spoke to that is completely opposite 30 years of practice by not just the banking agencies, but the SEC itself and Congress. I think the Dodd-Frank Act and the Volcker Rule, for example, make it clear that Congress and the regulators respect the difference between loans and securities. So taking a radically different position to that would be strange also. And third, and perhaps most importantly in the context of what we're talking about, and the answer to your question is, if the SEC could have always taken the position that loans are securities, but they would have done so in a organized administrative process that would have reached out to the stakeholders, to the public. What do you think about this? What do you think about that? The work that we did, and we've been focusing on this issue for many years, particularly since the case went before the Southern District, is we found that every rock you turned over, there was something else. There was another issue that you hadn't thought about, and it was so complex. Just the relationship between the banking agencies and the SEC was so complicated that this was not the forum to turn everything upside down. If the SEC wants to go down that path, they really should be doing it through this process. I'll give you just one example. The Glass-Steagall Act, which everyone thinks is gone, is almost gone, but there's a remaining part that is very problematic for banks if loans were to be securities. Banks can't hold non-investment grade securities in their banks. Right now, the loan market is booked in the bank and trades out of the bank, not a broker-dealer. If the bank had to suddenly move the loans to a broker-dealer, it would be the end of the world as we know it. And I know that sounds like an exaggeration or a crazy statement. It's not. Again, because I don't have all day and I don't want to really bog this down, there are capital implications, there are trading implications, there are FINRA implications, go on and on and on. That's just one issue. So the point we were making to the Treasury, to the banking agencies and the staff was, this is just so complicated. You don't really know. We know there's a lot of bad things, but we really have no idea how bad and how complex. I think when the commissioners met, on the Thursday before July 18th to discuss this, they just were not willing to take that policy step in this context. And again, I don't know who said what to whom. It's impossible to know that, although I'm trying to find out, but unsuccessfully. I think at the end of the day, they rightly concluded that this just wasn't the right forum at the right time in an economy that's that's under pressure to take such a radical step without really figuring it all out. So I commend them for that, for not going down that path. And we're pleased because it goes back to the court to decide it on the record. And I feel strongly that that record was pretty clear that the loan is not a security, given just on the Reeves test and all of the other factors that we made clear through our amicus brief, and that the banks made clear in their briefing as well.
Thank you, Elliot. That's enormously helpful. It seems like this is a very important decision that's going to affect the capital markets, that ought to be made either by Congress or the SEC after their typical legislative or regulatory process, and not by a court in a single case. But that's where we're left. So hopefully the right decision is reached and our capital markets are not put into turmoil.
Absolutely.
Well, thank you so much for your time. Really appreciate your participation. Nick, thank you very much. And we will see everybody back at the next SEC Roundup.